Right now, stop scrolling, because what Vietnam just did with its currency could quietly reshape how emerging market money moves in 2026, and if you follow global finance even casually, this is something you cannot ignore, so like this video, right? Now comment where you are watching from and subscribe, because this channel breaks down complex currency shifts in simple, real language, and today we are talking about Vietnam making a key currency move as the new Vietnamese Dong rate takes effect in 2026, and why this decision matters far beyond Vietnam itself, as global markets remain sensitive to inflation, interest rates, and confidence signals coming from central banks across Asia and beyond. Vietnam has been operating under a managed exchange rate system for years, which means the central bank does not allow wild, free-floating movements, but also does not strictly peg the dong. Instead, it carefully adjusts its reference rates and liquidity tools to maintain stability while supporting exports, controlling inflation, and protecting investor confidence. And as 2026 approaches, the updated dong rate framework reflects a calculated response to strong external pressure, mainly from a firm US dollar shifting global interest rate cycles and capital flows moving in and out of emerging markets at record speed. What makes this move important is not hype or rumors, but the timing, because Vietnam's economy has grown into a major manufacturing and export hub with deep trade ties to the US, China, and Europe, so even small exchange rate adjustments can influence trade competitiveness. Foreign investment costs and domestic price stability policymakers are walking a tightrope, because a weaker dong helps exports but increases import costs, while a stronger dong supports inflation control but may reduce competitiveness, and this balance is exactly why the new rate taking effect in 2026 is being watched closely by currency analysts around the world. Another critical point is that Vietnam's central bank has built credibility over the years by acting early rather than reacting late, using tools like reference rate adjustments, market interventions, and liquidity management to prevent panic moves. In this steady approach has helped Vietnam avoid the extreme currency volatility seen in some other developing economies. And this is where global currency watchers and even Iraqi Dinar followers pay attention, because emerging market currencies often move in cycles influenced by similar pressures such as US monetary policy, geopolitical risk, energy prices, and investor risk appetite, while the Vietnamese Dong and Iraqi Dinar are not directly linked. The policy signals matter because they show how governments manage reform, stability, and confidence rather than chasing sudden revaluation headlines. Nam's approach shows that currency value is shaped through discipline, trade performance, inflation control, and long-term planning, not overnight miracles. And as 2026 unfolds, analysts expect continued cautious adjustments rather than dramatic shifts, with authorities focused on keeping inflation contained, supporting growth, and ensuring the financial system remains resilient in a world of uncertainty for everyday people. This matters because currency policy affects prices, jobs, wages, and the cost of living, even if you never trade Forex. And for investors, it reinforces the lesson that sustainable currency strength comes from fundamentals, not speculation. So, if you want to understand real currency movements without noise, this is exactly the kind of signal to watch. And before you leave, make sure you like this video, share it with someone who follows Forex or economic news, comment your thoughts below, and subscribe now, because more clear original currency updates are coming, and you do not want to miss what happens next.